All right, we are live. Welcome to another edition of True North Accounting's webinar. This one is on accounting basics. So we're going to walk you through some good stuff here. We're going to have time at the end, about 20 minutes left over for any questions you want to throw at us. And as always, we have on the bottom of your screen there, bottom right, we've got two features, ask a question and polls. So if you do have questions, put them in the, just so they don't get lost in the chat potentially, put them in the ask a question box there, and other people can upvote them, and then we'll just start with the one that has the most votes. So we make sure to, we always get to them all. So well, maybe not this time. Polls, there's a couple poll questions in there. So it's always good to see people's feedback on these things, just so we can get an idea of what people are thinking, what they're using. So pop in there, tick off one of the four polls. And we'll dive right into this.
Yeah, thanks everybody for joining. And it's June 17th. It's beautiful outside. So yeah, if you're in here, good on you. You must really be looking to learn today. So hopefully we make this worth your while. And yeah, Curtis will take us through who is True North Accounting.
Who is True North Accounting?
And I'm Matt. I'm Matt, by the way. So I'll just get that out of the way. The first one on the list here. Curtis.
I'm Curtis. You can see us in the picture. And little known fact that Dill was actually taking this picture. So Dill's joining us. He's a CPA senior manager with us here. And that's us. We're a small business accounting firm in Calgary and Okotoks. And yeah, we're ready to talk about accounting basics. We're going to learn the basics of accounting to set yourself up for small business success, and we'll touch on the agenda and dive right in, just so you know what we're going to be talking about. So 4 to 4:40-ish, we're never perfect here. Accounting basics every small business owner should know. So we're going to touch on where does bookkeeping end and where does the accounting begin. We're going to talk about adjusting journal entries. We're going to talk about the notice to reader financial statements that we actually produce. We're going to talk about the users of the financial statements, often overlooked item by a lot of people. And we're going to talk about the CPA difference. And then at the tail end, last 20 minutes, we're going to be here to answer any questions that you voted up, put in the ask, or just if we kind of run short, we'll be here to just answer just about anything.
Okay, great. So for bookkeeping versus accounting, well, first thing we want to talk about is that, is it echoing right now?
No, you're fine.
Okay. So the first thing I want to talk about is that bookkeeping versus accounting, and at the end of the day, bookkeeping has a point where it ends and accounting starts. And that piece is really when all of the day-to-day transactions and activities in the general ledger have been accounted for. So when you went out and got a meal, you can go ahead and say, okay, I recorded that. The bookkeeper will record that, and that is the extent of what they need to do. After that, what happens is that the accountant will come in and look at those trial balances, and what they'll do is do all the adjusting journal entries. And once those journal entries are done, then we can start moving it over into the financial statements. So as I mentioned, the first step is just recording the transactions, and that's done through the general ledger. After that, the general ledger is used to create a trial balance. And we have an example that we're going to kind of walk you guys through as we go through this. Now, okay. For bookkeeping and accounting, at the end of the day, the accounting is done, and it takes all the bookkeeping data and it uses that, and it provides financial insights for the business. The accountants take the trial balance, they turn it into financial statements, which are always going to conform with the CPA accounting principles and the tax laws. The final deliverables of accounting are going to be the financial statements and the corporate tax return.
And there's often like a kind of a faded area where most people don't really, what's the difference between bookkeeping and accounting? Like, where does it actually end? And to kind of sum it up in a brief statement, like, your bookkeeping and doing the bookkeeping of bookkeepers, taking all of the transactions that are running through the statements, the bank and credit card, that's recording all of that is the bookkeeping. And where accounting takes over is where it gets to a little like a higher level of complexity. Essentially, there's other adjusting entries, other things to record that are bringing the in totality to create the financial statements. They're bringing them up to like they're ready to submit to CPA, like or as a C, like they comply with CPA laws and they're ready to submit to CRA.
And so for when we talked about this, like we said, the example. So in the next slide here, we can show this is a GL. And as you can see in this, the meals and entertainment, you can see all the different meals that the owners bought. With all of those meals, you see the net movement in the cash, and that's that 1442. And when we talked about it, we go from the GL and it moves into the trial balance. So if we go to the next slide, you can see here in the trial balance, the meals and entertainment, it's the total of all of what you saw in the GL, and it rolls into the 1442. As well, the motor vehicle expenses, as you can see here, the 2250, that rolls in again to the trial balance. The big thing, and we're going to touch more on this as we go, but the thing we need to understand is that the initial trial balance is completed by the bookkeeper. And as Curtis mentioned, when there's adjustments and more professional judgment that's required, that's when the accountant comes in and steps in.
Okay, thank you, Dill. So yeah, like Dill had explained, the bookkeeper gets the trial balance and general ledger in place, and then the accountants come in and do all the adjusting journal entries. The abbreviation for adjusting journal entries is AJE. So you'll see AJE a lot through the presentation. I just realized we didn't put that in brackets to let you know. So AJE is adjusting journal entries, and those are all the write-offs that accountants do to add to what bookkeeping has already been done, all those day-to-day things. Anything that didn't go through the bank or additional write-offs plus taxes, we'll go through all of those. So the main ones we'll go through is accounts payable. So, and we'll explain what that is, but that's part of accrual accounting versus cash accounting. And then we'll go through the gray areas, like the business expenses that, or they're not 100% business, they're not 100% personal. So there's a bit of a split, and they might have not gone through the bank, or they might have not gone through the bank account of the business. They're going through your personal bank accounts like home office and vehicle. And then we'll talk about loan balances and interest, taxes, that's the big one. And other accruals, those would be things like you receive a deposit for work that you haven't done yet. That would be like unearned revenue or deposit. So that's actually a liability at year end. Or maybe you've prepaid your insurance for the year, or you've prepaid rent, or you have a damage deposit with your landlord that that could just sit there until you move out. There's lots of things that just sit on the balance sheet as assets or liabilities that are considered accrual. So there's various different types of accruals. We won't get too deep into too many of them, but the one that everybody asks about is the shareholder loan and how that works. So some of the examples we have affect shareholder loan, and really that just means the owner of the business. In a small business, it might be business partners or a couple or a single person, but there's usually like startup costs or just business costs that the owner has paid personally over the years and grows that balance up. And so we'll talk about how that moves. So the first adjusting journal entry that we would consider is accounts payable. So here's an example. On your year end is January 31st. On January 29th, your lawyer sends you an invoice for $1,800 for hours worked during January. The invoice is due a month later, so February 28th, which is into the next fiscal year or financial year. But the expense was basically, it relates to work done in January, you pay it in February. So it didn't go through your bank account, and so it didn't get captured in the bookkeeping. It's not in the general ledger quite yet, so we have to put it there. because you know you owe that money on January 31st. So that's an example of an accrual. So the debit, like all these adjusting journal entries are in the format of debit and credit. That's just the like two-sided bookkeeping. Yeah, so the debit would be your increasing professional fees expense for 1,800, and the credit is your increasing the accounts payable line item on the balance sheet. And so we'll see how that adjustment looks on the trial balance after we go through a few of these examples. But in this one, yeah, February 20th, you pay it, then you reverse the accounts payable entry, and your cash is decreased. So you pay it, cash goes down $1,800, and you can clear out that accounts payable liability on your balance sheet. Another example is these gray areas. So business expenses paid personally. So gray areas aren't 100% business, they're not 100% personal, and like a knowledgeable accountant really has to apply professional judgment to recommend a reasonable split on this. Home office is a great example. It's based on square footage of your home office, which has to be like dedicated office space. So usually it's like a bedroom. It's easy if it's like a 10 by 10 bedroom, so 100 square feet, and your house is 1,000 square feet. Then you get 10%, you get to write off 10% of your rent, or if you own the house, mortgage interest, utilities, property tax, insurance. Another one is cell phone. Most people just have one cell phone, and it's going to be, I guess the use varies, how much is business and how much is personal, but typically most people use it for both. Like everybody would love it to be 100% business, but they're still going to sometimes have their like hockey pool or text their friends, text their wife, or kids, whatever it is. So there's going to be some sort of business and personal split. Same with home internet. A lot of accountants would lump home internet in with home office and only take it at the 10% split. But most people, especially during COVID, having that home internet is absolutely critical to running a business. So I think it's very reasonable to have a 50-50 split on that home internet. And then vehicle expense, unless the company owns the vehicle. I guess even if they do, there's going to be a personal use portion, which is like a taxable benefit. So you'd have to do the adjusting entry the other way. In this example, it's the business owner using their personally owned vehicle, and then we just calculate $1 per kilometer. We use 58 cents a kilometer in this example. It's actually gone up to 59 now. But so these are the adjustments we want to do in this adjusting entry.
And just to add on top of that, it's another example of the bookkeeping isn't going to capture these. These aren't running through the company statements. These are stuff you're paying personally, but you want to claim the expense for and get the credit from your shareholder loan. You want to repay that to yourself tax-free. So it's oftentimes not found in the bookkeeping when the bookkeeping's done, and it requires additional calculations, professional judgment, and then recording some adjustment entries to make sure the business gets maximum write-offs.
Yeah, it's a big value add that accountants do is we scrounge up all those write-offs that might have been left out otherwise. So we want to maximize all your write-offs and minimize your taxes. So this is a template that we use with our clients, and it's just to capture all the costs, like your utility bills. I just use some simple, like the average amounts over the year. So insurance, $90, heat and electricity, averaging $260 a month. Your mortgage interest, that's the big one. It's not your full mortgage payment. So you might pay $2,000 a month, but that's not all interest. You're paying down some principal in most cases. So you want to look at your mortgage statement to get that interest number on how much you paid. And then property taxes. So you sum up all those, your total cost of living, $16,300. 10% is for business based on square footage. And so you get $1,630 for your home office. That's a business expense, and your business can pay you back that money, and that's tax-free. So we're going to add the internet and cell phone portion to the just the office expense category. And so we're taking 50% of internet and 50% of cell phone. And so that's another $1,200. So we add 1,630 and 1,200 to get the $2,830. That's, you can see in this journal entry, debit office expenses, so we're increasing office expense in the company, $2,830. And then the other side of that amount is in that due to shareholder, because you personally are paying for all those expenses. So now you're getting credit. The company can pay you that back and it's not taxable income. And then we have the vehicle calculation, which is, we've simplified it a lot. 3,880 kilometers were driven for business. This business owner had used MileIQ to track all their trips. There wasn't a lot in this year because of COVID. They worked from home a lot. Usually that number would be 15,000 kilometers. But yeah, pretty parked at home during this year. So 3,880 times 58 cents is just 2,250. Pretty simple. The business gets the deduction of 2,250, and then they repay that to the shareholder the same amount. So this is the entry for this gray areas. So this credit to shareholder loan increases the amount payable back to the shareholder. And when it's repaid, it's not income, and therefore it's not taxable.
Okay, so for loan balance and interest, as we chatted about, there's the difference between the bookkeeper, what they do, and what the actual accountant does. So accountant would actually look at the mortgage balance, and even though the bookkeeper may have recorded it as a full amount of $67,270, the accountant looks at it and says, okay, some of that has to move over and has to be an interest expense. What is important is to understand that moving a portion of that liability and moving it into an income statement as an expense, that's a part of the job of the accountant. And those big changes that happen between the bookkeeper and the accountant, we'll talk about at the end, but there's a lot of adjusting journal entries that they go through, and it takes the trial balance that we talked about and makes an adjusting trial balance.
This is not just mortgage, any loans, any lines of credit, anything that has interest mixed with principal. What we see most often when we get bookkeeping from a client or from another bookkeeper, if you don't know, it's easier just you see that payment to TD Bank or BMO or ATB, and you just put it against the loan. You're paying down the loan, but then it doesn't match the statement at the end of the year because the interest wasn't accounted for each and every time. So it's another common one you see with the adjusting entries, and you see us doing, see accountants doing.
We'll come back to this actually. Okay. So anything else to say about this entry? Okay, we'll move on to taxes. Okay, this is the big one. This is like where the accountants are basically taking the bookkeeping and calculating the taxes. And there's these few steps to make sure you're getting all the write-offs before you do the tax return. So yeah, you want to make sure you've captured everything you're going to in terms of write-offs and extra revenue or whatever. You want to make sure all that's adjusted for before you start the tax return. And then you complete the tax return to get two numbers, the income tax expense as well as the income tax payable, because they're not always the same. The expense is the 11% of your profit during the 12 months. And that's basically what the company owes on that profit. For the tax payable, there might be some like losses carried forward or a refundable portion of tax that we don't need to get into that piece of it. Or just you might have made your installments during the year or had a refund last year that you just applied to installments this year. So there's a few things that can cause the two to not exactly line up. Plus there's the federal and Alberta portions. So this is like the T2 summary from the tax software we use. And this is what gets generated and summarizes everything we've done in the tax return. So we put in the full income statement, and then this is the net income. and then there's the taxable income. There's no adjustments there. Sometimes these are different. But federal tax owing is 11,133. What's not showing on this is the Alberta income tax owing, which is the 2480. But the 11,133 plus the 2480 is the full $13,000 tax expense. But we've made tax installments of $6,600. So these two amounts are the tax owing for the January 31st year end.
It's
So
a complicated one. It's difficult to explain, but Matt's got it laid out here pretty good.
yeah, I did want to just show this one here. So this trial balance, this is what the bookkeeper had done. And so during the year, 6616 was tax installments made throughout the year. And so that the bookkeeper put to income tax expense. Now we did the tax return. We've calculated the full tax expense is going to be 1361. So we just add the 6997. And then these two entries here are the amounts that still need to be paid.
And
So I
just
just
to
wanted
highlight
to-
the difference, like the opening balance is on the left under the bookkeeper column. Like oftentimes, until all the adjustments are done, you can see the adjustments in the middle column. So the left side column under bookkeeper, like it has the change in motor vehicle office, professional fees, interest, income tax expense, and the difference in the shareholder account and the mortgage payable, like the change after all the adjusting entries are done, can be really significant. Like it can mean the difference between correct and not correct at the end of the day. Or you give your financial statements to a bank and they see liabilities that don't even exist, or they're recorded at the wrong amounts, or you're paying too much tax because your write-offs are not captured. So it's a good way. This is a really good illustration of how much can change just from 4 adjusting entries, 4 common adjusting entries, not to count so many others that potentially could be there too.
Yeah, and look at how many of those adjusting entries are additional expenses to the business that wouldn't have been captured otherwise. Motor vehicle, office, that lawyer bill, and the interest. So that's just reducing the amount of tax you owe. So yeah, here's the entry that just kind of trues up that tax owing after the installments. So income tax expense, $13,613, which is essentially 11% of the net income or taxable income. But federal installments were paid. So that 13,000 is made up of Alberta and federal, 9% and 2%. But the installments were just going against the federal portion. We don't need to dwell on this too much, but yeah, that's a summary of taxes. And then this is a summary of the 4 entries we made. And every entry, again, has 2 sides, a debit and a credit, and they have to equal. And sometimes, like generally, if you look at all these, it's one entry, like the debits are all hitting the income statement and the credits are all hitting the balance sheet. So there's always that 2-sided effect. Like when you say you go to Home Depot and buy a 2x4, your 2x4 expense account, supplies or materials, that goes up by how much is the 2x4 these days? Like $27. So yeah, your 2x4 expense goes up, but your cash or your credit card balance changes on the other end. So there's always 2 effects that are happening. Okay, so and then this is just like a snapshot of which accounts on the trial balance are affected, but here's the full. I know this is blurry and small, so we don't need to you don't actually need to see all of this, but this is this first column here, as Curtis mentioned, this is what was prepared by the bookkeeper, and then these are the adjustments we just made. So this, this is the adjusted trial balance, which just maximizes all the write-offs, moves some things around. And next, we turn it into financial statements. Okay, Curtis, you want to take this?
Three critical parts to the financial statements. The actual report, so the notice to reader report, compilation engagement report, they're being called. There's a few changes in the way CPA Canada is having things named. We won't dive too deep into that. It's not fully implemented yet, but you're going to have a report essentially saying a CPA firm, an accountant has prepared these, what they're for, who they're for, what they're for. And then you're going to be the two most important statements, like Matt just previously said, balance sheet and your income statement. Those are the two staples. They're always going to be there. There's a couple additions. Sometimes there's notes to the financial statements, possibly a cash flow statement, but definitely not required. But yeah, balance sheet. And here's a quick snapshot. They're all mini, but you can get an idea. If you've seen financial statements from us, you've probably seen something that looks very, very similar. So notice to reader report, income statement, balance sheet, containing the total of that fiscal year. Just the trial balance we're showing you. What's this? Are we highlighting?
Yeah, this is just to highlight the balances that were adjusted, and this really ties, all these account balances tie to the financial statement balances that are in here. So it's really just reformatting this into the two different statements. Okay, I can talk about how, so this has all the accounts that are in the financial statements, but you can basically draw a line right here between income tax expense and bank. The top portion is the income statement, the bottom portion is the balance sheet. And the balance sheet is really, it's on your year end, on January 31st, these are all the balances of things your company owes or owns. So cash balance on January 31st, that should be that's a fixed number. There's no time, or there's no activity being recorded on there. The income statement is where all the activity in the 12 months of the year, all the activity that your company transacted on. So that's all the revenue, all the expenses are captured on the income statement, and then at the end of the year, sum it all up. What's the effect on different balance sheet accounts? And the two, as the word balance in balance sheet implies, the two connect to each other through the net income and the retained earnings. So that's how all assets need to equal the sum of liabilities and equity, and you got to put net income in there as well. So it all has to work together.
The big key is that you can never actually have one without the other. So you're always going to need your income statement, and it's going to roll into your balance sheet. And if you continue going further, you would need all that to roll into your cash flow statement. So all of the financial statements, you need them, and they work together, and that's how this all goes.
Good. So why do I need financial statements anyways? Can't I just run my business from my Xero account or my QuickBooks account?
Why do I need them? Why do I need them, Matt?
So it's not, think who needs them, not why do you need them. It's the users.
The users of financial statements. And this term, users of financial statements, is often not even heard. It's not even used very often, unless you're in a meeting with accountants or bankers or something like that. So who are the users of the financial statements? They're more than you often think. By just off the top of your head, if you name a couple, or hopefully we list more than you can name off the top of your head, but let's see, we'll talk about them because there's some important ones. Who's using the financial statements? So who are the users of my financial statements? The CRA, obviously, we'll touch on that a little in the next slide, but a really, really important one, like mortgage broker and your banker, they can be the biggest key users of the financial statements. If you ever need loans, lines of credit, any form of financing, if you're ever going for a home purchase, they they don't want just a printout from a bookkeeping system. They want notice to reader financial statements at a minimum. And so it sort of sets the bar of they're looking for something that they can rely on, where they know the standard of the financial information that they're actually getting handed to them, and they can understand it because it's in a certain format that has a high standard and comparability. So credit card companies, vehicle financing, lease, if you've ever tried to, especially in a company, if you want your corporation to purchase a vehicle, what are they going to ask for? They probably want to know, well, what's the financial condition of the company? Can it afford to pay me back? How much does it owe? Is it in tremendous debt already? Where do all the answers lie? They lie in the financial statements. So landlords ask for them. There's other ones. This list can go on. We've just listed a few, right? The major ones, like telecom, utilities, tip, anyone you pay monthly, really, anyone you owe or are owed from. But CRA, I want to touch, if we just roll to the next slide, CRA obviously uses them, right? The financial statements, the corporate tax return. This slide doesn't really come across, you can't really see it, so I'll explain this. But every single corporate tax return has this schedule. It's Schedule 141. And there's two really key pieces of information on this. The first tick box, it says, does the accountant have a professional designation? And then down sort of where the mouse pointer is, a little near the bottom of this, it asks the type of involvement with the financial statements, and completed a compilation engagement, which is a notice to reader financial statement that a CPA would provide. Those are two pretty critical things, as when CRA gets a corporate tax return submitted, if they see one and they're like, oh, the accountant doesn't have a professional designation and they didn't even do a notice to reader report, like who put this together? What kind of, they have, so it instantaneously either sort of puts you on one side of the fence or other, as far as CRA having confidence in the information being like transmitted. So
do you think having the designated accountant prevents audits more? Like, do you think they would actually look at that if they're looking at like they have, the CRA is underfunded, they don't have a lot of people to be out there auditing. Do you think this is something they consider?
Dale and I were talking about this earlier today, and we were trying to come up with a good estimate of like percentages. And I was kind of saying, like, if you tick off your accountant has a professional designation and you completed a compilation engagement, you probably land in this little bucket of like 2% random audits where they just have to draw some people to stay on top of it. And if you're ticking off, like if I'm CRA and I see, okay, any corporate tax return where the accountant doesn't have a professional designation, no notice to reader, put those in another bucket, and I'm going to look at like half of them. I'm gonna really pick these apart. So I think it's not a lot of people know this exists. Not a lot of people have ever seen this schedule, but every single corporate tax return that gets submitted has this schedule, and it's either ticked off yes or no, or it's not. And it's good for people to know. Even if you're working with an accountant, you're not sure, like go flip through your corporate tax return and find that schedule. You'll see.
Yep. And the most important user is you. Well, and your stakeholders. And what we mean here is like, you might be fine making decisions day to day for your company using your QuickBooks or your Xero, and that could work for you. But say you fall off the ladder or get hit by a bus or something, who's gonna be putting together the pieces of your business, your finances? Everybody that relies on you and relies on your business is going to rely on these financial statements. They're not going to be able to dig into your QuickBooks account and figure out who you owe money to and who owes you money and what's the value of the business and how much did you actually earn last year and their profit and your profitability. Having a CPA prepare financial statements, puts everybody like apples to apples, and like everybody's following the same generally accepted accounting principles, and profits calculated consistently 1 year to the next. And you can't just make up expenses without it having effects on the rest of the trial balance. Like that's the beauty of the trial balance. Like it has to make sense. You can't make up expenses, or you can't just make liabilities or loans disappear without having some other effect. So think about everybody that's going to be relying on these things if you're not able to. So obviously your spouse, the executor, or like, and the beneficiaries, who's going to be looking after, or who's getting the pieces of your life when you're not there. The lawyers trying to sort everything out, and spouse and lawyers could go for a divorce. Like that could be the case in a divorce as well. Or if you're not able to work and you're trying to bring in somebody else to run the business, huge implications there. Your life insurance company, critical illness, disability, those payouts in conjunction with like your pension plans and other income streams for your business. Yeah, these people want to verify that like you have disability coverage based on a certain income level. They're going to verify that by looking at your financial statements. Or that's one piece for sure. And then once you're collecting some government money, it's all income tested, and the CRA again will be looking at that. And then if there's the whole philosophy, if you're going to build a business, build it to sell. So if you ever are thinking of a business transaction, either succession planning for retirement, maybe you have somebody looking to buy you, or you're looking to buy somebody else, or just sell to retire, or maybe there's employees that are working hard and you want to share in the profits and maybe give start like an employee stock option plan. All of these potential transactions will rely on like years and years of consistent quality bookkeeping and accounting. And
I think like from what we've seen, and what happens is that a business isn't even ready to sell, but an opportunity comes up and they're like, hey, here's somebody that wants to buy my business. They want your books. They want to see your financial statements, and you're not ready to go. And I've actually seen this, and this is a huge problem, because then somebody runs and says, oh, I need an accountant to look through my books, make sure my financial statements are good. But because it wasn't timely enough, you've lost out on a sale. So being prepared in advance is very, very key with your financial statements, with your bookkeeping, because you never know when an opportunity is going to present itself.
And usually a minimum of 3 years too, 3 to 5. If you're ever talking merger, acquisition, if you're trying to buy a business or someone you're trying to sell, you don't want just the last year. Like you want enough data and reliable data to make a good decision on.
Yeah.
And this is just the wording of the notice to reader financial statements that might not make sense to you the first few times you hear it. Like that's just awkward wording. Like what does that even mean? And like we talked about how there's the balance sheet and the income statement, and then just before, like say your life insurance company is reviewing your financial statements, this is like blasted right in front of them. Like these financial statements were prepared by True North Accounting professional chartered accountant or chartered professional accountants, and this is a notice to reader engagement or a compilation engagement, so we did not audit or review. So it's kind of setting the stage for like how verified were these, or how much work was put into these financial statements. We don't need to get into audits and reviews, but like generally public companies are all audited. Big private companies or charities, anybody with like big loans, they get reviewed financial statements and notice to readers, like the lowest level, but still prepared by a CPA.
Curtis, you want to peer review? So this is something we stress about, but at the same time, this is why we internally work so hard to keep ourselves on par, essentially. So CPA Alberta, every 2 years, they look at the work of every single CPA firm in Alberta. And they want to make sure they keep everyone accountable. And if an accountant's doing such poor work, and that they'd eventually get shut down or have their designation stripped from them. So they are held to a high standard. The level of quality, there's every 2-year period, a big chunk of these get looked at, and it gets pretty detailed. I tell you, we're having ours coming up now, and it's part of the time where we are really on high alert, because we're just making sure that let's keep everything as high. We set a really high bar, so nothing can possibly ever anger the CPA gods, in a sense. So, and I think True North, we do a really good job of it. I make sure we do. We all make sure we do. So it is the signature line on that notice to reader report signed by a CPA firm. Actually, it does mean something beyond just a financial statement printed from a bookkeeping system. It does tell you that there is a lot in the background that goes on behind the scenes to make sure it's good.
And Curtis, do you want to tell us about how working papers support the financial statements? And I guess before you do that, I just want to remind people that there is the ask a question function. So if you have any questions about any of this, get in there, ask it, and we'll answer. There's none in there right now, so we're just going to keep talking until there's some questions in there.
See, I think we're setting a record today. We're doing such a good job. Not a single person has a question. Maybe that's the case. We'll keep going though. So working papers, essentially, this is what CPA Alberta is looking at. When we create a financial statement, we're not just taking numbers and putting them into a template and making a financial statement. There's so much more, from the buildup of looking at the bookkeeping to verifying not verifying every single, I should watch how I phrase it, but I think we have an example later on. But this, from the simplest form, right here. So if the simplest example is cash listed on the bank statement. And you might just see the financial statements, but behind the scenes, what's happening is we need to show that we've double checked that is the exact cash balance as of January 31st, 2021. And we have the supporting document to prove it. So often bank statement's pretty easy, cash balance is easy. We've got a printout of the bank statement showing the cash balance that matches. And it gets quite a bit more complex as you go down and you get to some of the more detailed or complex balances. But the verification process, it's not just taking numbers and plunking them into a financial statement. There's quite a bit behind it, and that's essentially what CPA Alberta does when they do their peer reviews. They do their practice review, and they want to make sure that you are doing everything you need to, and you're not skipping steps, you're not missing anything. Bulletproof financial statements.
And another example of this is when we talked about adjusting journal entries for mortgage. We have the mortgage, but then we were like, hey, we need to calculate mortgage interest. We would do an amortization schedule, have that set up as a working paper, and showcase how we got to the mortgage interest and why we recorded it in the income statement, and made that adjustment journal entry.
Mm-hmm.
And this slide here, I know previously Matt and I have kind of had conversations on how it works in the not off sector, but non-CPAs, accountants that aren't CPA firms. They're not technically required to do this level. And because they're not CPAs, maybe they're not registered with the Institute, so they technically shouldn't be issuing any type of notice to reader engagement. But there's no one really keeping them accountable, so they don't have to check in with anyone. CPA firms have oversight that ensure the work's done properly, so the stakeholders, users, they know what they're getting when it's signed at the bottom, True North Accounting LLP. But it is funny. We often see, sometimes we've seen prior accountants where we look at them and it's like, well, this doesn't really make sense, but nobody's actually checking on your stuff, because I guess realistically, it's a bookkeeper putting just preparing a printout of the financial and the T2, and there's nothing wrong with that. If you don't need notice to reader financial statements and you're comfortable with the level of what's going on, then it might be fine. It might be all you need, but there is a difference. And no accountability in that sense, or comparability, is one thing that struck us before. It made us kind of think about.
Yeah, not anybody can call themselves an accountant, and there's such a wide range of skills in the undesignated accounting world. So some might be really good, or some might just be taking your QuickBooks entries at like what you did on your own at face value and dumping them into a different format and doing your tax return. And we see files from other accountants. It's like, where do they get these numbers? This is not making any sense. And there's like plugs that can make it all balance. But yeah, you can see right on the notice to reader page on your financial statements, if it's a chartered professional accounting firm, it has to have that in the name. Like that has to be in the legal name of the company. So if it's like True North Professional Corporation or something like that, then it's not a CPA firm. And you can have a CPA with a accounting firm, but it doesn't mean it's a CPA firm. And technically they shouldn't, but they might not be a Canadian CPA as well. So yeah, that CPA in the name, that's what you want to look for. And yeah, CPAs do charge a little bit more because there is that whole piece of having the working papers and needing all that documentation, needing the sign off, needing to keep everything for 7 years. And then we get audited every 2 years on the work we've done. So they're taking a handful. They'll probably pick 10 of our clients, and we have to send our working papers to Edmonton, and somebody there is reviewing everything, how we did it, and giving us a report card on that. And then there's also CPA, like professional liability insurance. So if we screw something up really bad, you, as a client of ours, you can go to the CPA Alberta board and report us or make a claim. And if we're not doing our job right, or like there is that watchdog or that whistleblower entity, and it's across Canada. So there is somebody to report us to, where, yeah, if we were a wild, wild west accounting firm, there's nobody to complain to. And your finances are a big piece of your business. Like if you do have any significant financial plans, you want to have good financial records.
I've got a live example actually today. A client that I know pretty well, they emailed me, and I came in this morning, I checked my email, and they needed some financing. And I won't touch on any of the details, but they forwarded me an email, and it was an ask from their financial guy. And it was a big ugly list of stuff they needed. And it included notice to reader financial statements for 2 years, amongst like a big chunk of other things they wanted. And the simplicity of already having it done with us for a few years meant that I was just able to drag and drop these things right to them, plunk, send, and I'm like, hey, forward it to your financial guy, and you've got everything you need. And it was, that might be the smoothest financing thing he'll have for long. If he had not had notice to reader financial statements, panic ensues, and he's probably not getting the funds that he's after. But it was just, that actually happened this morning. So
like just as an example, like a CP, just for the year end, if the bookkeeping's all done and we're just doing the tax return and the financial statements, a CPA firm will charge like somewhere between $2,000 and $3,000 to do all that work, whereas a non-designated accounting firm will charge like $1,000 to $2,000. So it's probably like call it a $800 difference on average in price. But if it means the difference of getting a $500,000 loan or mortgage or operating line, that's a pretty cheap investment. But yeah, I would think of it as an investment.
Not being audited. Like there's other, besides the financing, the other preventative measures. It's almost like buying a brand new Rolls Royce but not getting collision. You got this smoking hot business, it's doing so well, and well, you got in a car accident rolling out of the dealership, and now you didn't get collision on your insurance, so you just got the basic liability, and guess who's paying for all the repairs?
Exactly. Okay, well that wraps it up. No questions. I guess we can go home early today. Okay, thank you everybody, and this will be posted on our YouTube account or our YouTube channel. If you haven't seen that, we have all of our webinars posted. We have some other videos. Yeah, so check it out, subscribe, and yeah, we've been doing these monthly. So you can subscribe and Crowdcast as well. Hope you guys got something out of it, and yeah, enjoy your summer. We may be here next month. We haven't decided yet.
Thanks, everyone.
Yeah, thanks for coming.